That's that. All right, so welcome back, everybody. Today we're going to be going over Chapter 3 and also reviewing Chapter 2's homework. I want to go ahead and just point a few things out. I was late getting these quizzes for Chapters 1 and Chapter 2 put up. They're just short little 10-question multiple choice quiz for Chapter 1. You can see it's in the previous week, the past week right here. You can see the link here, I believe.
I don't think your TV's on.
Sorry, that one back here is on, so it's got me thinking that it is. I never turn this on, so I apologize. You're going to have to tell me that every class you'll have to remind me.
You can ask her. We dealt with Lester. You're fine.
Yeah.
All right, cool.
We'd get 30 minutes through the period telling him, hey, it's off, and he'd still
He'd just keep on rolling. All right, well, makes me feel a little better, because I know I'm terrible about doing that. So yeah, Chapter 1 quiz. I believe it's 10 questions, all multiple choice. You have 15 minutes. I didn't open it until this past Sunday because it slipped my mind. And I was like, oh gosh, I need to get it in here. But I'm giving you all till, I'm probably going to bump it till next Tuesday after class because that's when the homework, I believe, is what I have the homeworks due. I believe Chapter 1 homework is already due, but Chapter 2 homework is due on the 8th. So right now, as of now, it's saying it's the 7th. So you still have like a week to get this in. Same with Chapter 2. And all this is going to be great practice for the exam. So everything you're seeing, like question-wise, is going to be very similar to what you'll see on the exam. So, and with the first test that we have, chapters 1 through 4, it's all based upon consolidations. And then when we move on from that, it's something totally different topic. So, even though we're a little late, it's going to be great practice because it's all just building on each chapter till chapter 4.
So as long as we're able to do the problems that you assign, we should be good on the test.
Right. Yeah. The hardest problems you're going to see in this class is on homework.
Okay.
Quiz will probably on the quizzes and exams. Not saying they're going to be like easy by nature of the content. It's just it's a difficult course, but I like to give harder questions on homework because that really, and they're kind of comprehensive. It kind of covers the whole chapter. So if you get the homework, you should be totally fine. Homework, if you do good on homeworks and quizzes, you're not going to have an issue on the test. Not saying you might have a hiccup that day and have like a brain fart or something and just not perform. You know what I mean? I mean it happens to everybody. I mean,
you're not one of those that make them intentionally hard.
No, and I don't know if anyone here's had me. I know. My head just went blank. I'm sorry.
Clayton.
What? Clayton. Sorry. Yeah. Clayton's had me. He can probably attest that I give pretty detailed exam reviews and stuff. So I don't throw any curveballs. Now, I mean, it is still stuff we cover, but if you pay attention on the exam review, the day before, the class before, then there's no surprises. I mean, what I tell you is on there's on there. Now whether you learn it or not and apply it is obviously the ball's in your court on that, but I don't try to make it any trickier or difficult than it has to be. So there's Chapter 1 quiz. Just want to remind you, like you do have to go back, into Moodle a little bit to get to that link. Then Chapter 2 quiz is in the week of August 27th to the 2nd. So that's actually right where we're at this week. So that's not bad. Then I'll get Chapter 3's quiz up down here, and then that's how it'll roll moving forward. I do have Chapters 3 homework up already, so that it's available for everybody. So like I said, let's go ahead and we'll run through Chapter 3 real quick, get through the content. It's very similar to the last chapter. Last chapter was consolidation, the date of the acquisition. So it was actually the date that it occurred. And now this is going to be consolidation subsequent to acquisition that we're concerned with. Okay, so consolidated statements, subsequent to acquisitions, Chapter 3. We'll go ahead, I'll bore you real quick and just read the learning objectives that are relevant for what we're going to cover this chapter. First one, show how an investment in a subsidiary account is maintained under the simple equity, sophisticated equity, and cost methods. Complete a consolidated worksheet using the simple equity method for the parent's investment account. Complete a consolidated worksheet using the cost method for the parent's investment account. Describe the special worksheet procedures that are used for an investment maintained under the sophisticated equity method. Distribute and amortize the multiple adjustments resulting from the difference between the price paid for an investment in the subsidiary and the subsidiary equity eliminated. The sixth one, demonstrate the worksheet procedures for investments purchased during the financial reporting period. And then the last thing we're going to cover here is the learning objective number 7, which is demonstrate an understanding of when goodwill impairment is going to exist and how it's calculated. And like I said, learning objectives 8 and 9, I'm not concerned with either one of those right now. I highly doubt it's something you would ever see again. Maybe in practice, if you get to a really high level, you might see some of that. But for the most part, even on the CPA exam, I don't think you're going to have to worry about doing that. Okay, so let's start with accounting for the investment in the subsidiary, okay? Because if you remember from last class, we talked about the 3 different ways or 3 different levels of influence for an investor could have on a subsidiary, right? Do you all recall what those 3 different levels of investment influence are, or what 3 different levels of investment are? Just the names, or you don't have to tell me the actual thresholds of the percentages. That's what I'm talking about, the percentage. Like if I invest in a company, like remember, if it's less than 20%, it's the cost method, right? If it's between 20 and 50%, what method was that?
Influential.
Right. That means you have influential, meaning you're going to carry the investment using the equity method, right? And then lastly, what was the last one? Greater than 51%. What's that? Control, right. And what does that require as far as financial reporting? If you have a controlling interest in their stock, remember we're dealing with stock compensations now, not assets. So if you have a 51% controlling interest in a company, you have to consolidate at the end of the year, right? Because FASB says that we're concerned with one economic entity concept, right? They're still separate legal and accounting entities, but they're concerned with the one economic entity because they control that subsidiary, so they want to see the results for both companies as a whole. Okay, so we're just going to kind of expand on those 3 different types of ownership levels here. We'll start with the simple equity method. So under the simple equity method, we want to recognize the parent share of the subsidiary's net income, okay? So what do we mean by that? The parent share of the subsidiary's income. So say if we have if we own 60% of a company and they have a net income of $100, then we're going to claim $60 of that, right? So just the same thing, their share of their income. So the way that we're going to account for that on our books is we'll debit the investment in the subsidiary, right? And then we're going to credit investment revenue. Because if you remember, when we initially invest into that company, we have an investment account, right? That's carried on the balance sheet. Do you recall that from the previous chapter? So now all we're doing now throughout the period, because remember we're dealing with subsequent acquisition, right? So it's after we actually acquired 51% of the stock or greater, right? Because last chapter was dealing at the date of acquisition. Now we're worried about subsequent acquisition. So during the period. So now that subsidiary is making money, and this is how we're going to keep up with adjusting our income, our proportionate share of their income. So we'll debit our investment in subsidiary, credit investment revenue. Does that make sense to everybody? So that's increasing our investment account, right? And we're claiming it as revenue. Under the cost method, we're not going to do that at all. We're not concerned with the parent share of their net income, any of that, okay? So that's not even applicable under the cost method. Okay, now what if the subsidiary declares and distributes dividends? Under the simple equity method, this is going to be considered a reduction in the investment account, okay? So when we receive dividends under the simple equity method, we're going to debit cash because obviously we're receiving a cash dividend. But then the credit to that is going to be the investment in the subsidiary because this is considered a return on our investment, okay? Because we have an actual influential share in that company, right? So we're not counting it as dividend income. We're recognizing their share of income, as you can see up top. So we recognize their share of income, but then when they declare dividends, that's going to reduce our investment account. Okay, under the cost method, remember this is less than 20%, we're just going to receive dividends just as is. Debit cash and then credit the dividend revenue, just as we're used to doing from principals, intermediate, and all that. Everyone clear on that? Okay, so simple equity method, every change in subsidiaries' retained earnings is going to be recorded on a prorated basis in the investment account, okay? That means that's what we're doing here. That's what that means. So as they earn money, right, we're going to recognize our share. So that's every change in the subsidiary's retained earnings. So why does it say retained earnings there? Every change in the sub's retained earnings. At the end of an operating period, what does net income close to? Right. So at the end of a reporting period, then they're going to see at the end of the month, okay, well, hey, retained earnings grew. We're going to recognize our share. So that's why it's saying every change in the sub's retained earnings balance is going to be recognized in that account. Everyone good on that? Okay, under the cost method, the investment account remains as its original cost of acquisition balance. So meaning it never changes. We have our investment in it, and we receive our dividends, but nothing else changes. That investment account stays the same as what we purchased in on the date of acquisition. Okay, now we're going to compare the simple equity method to the sophisticated equity method, okay? So once again, recognize parent share of subsidiaries net income for the simple equity. Once again, remember we debit investment in subsidiary, credit investment revenue. Nothing changes there. When we receive dividends underneath the simple equity, same thing. Remember, it's a return of our investment, so we're receiving cash as a debit. And then we're crediting the investment in subsidiary account because it's reducing our carrying value in the investment. And then the amortization of excess, I'm going to get to that, but just for now, I'm just going to call it what it is, amortization of the excess. That's not going to be applicable under the simple equity method, okay? And this is one of the changes. This is an extra step. The amortization of excess that I'm talking about is different from last chapter, and we'll get to that as we move on. Okay, next, the sophisticated equity method. Once again, they're going to recognize the parent share of the subsidiary's net income, the same as under the simple equity method. So we're just debit the investment account, credit the investment revenue. So same thing. Receipt of dividends, same thing. Debit cash, reduce our investment account by crediting it. Okay, and then amortization of the excess. This is where we're going to debit investment revenue and credit investment in subsidiary, okay? So once again, that's reducing our investment in subsidiary account. Okay, so sophisticated equity method, it says the parent records controlling interest in the subsidiary's income. So we've established that. We see that right here. And then the parent also records the amortization adjustment for the excess. So what are we talking about there? Do you remember from last chapter, what were we doing with the excess amount? Remember, we paid an excess amount over the fair value of identifiable assets, right? And anything over the fair value was goodwill, right? But what about those identifiable assets? Because remember, we're concerned about the fair value, not the book value when we're consolidating, right? When we invest in. So what do we do with that excess that is not goodwill? Like say the difference between like building. Remember, say the fair value of the building is $300,000 as opposed to the book value of $200,000. Remember how we had to debit that to distribute the excess? So if we're going to account for those when we're investing, like as far as date of acquisition, right? When we're acquiring 51% of the stock, if we're going to increase the value of the assets from book value to fair value, what's something else that we're going to have to account for once we get into that operating period? If we've increased the value of fixed assets, what are fixed assets subject to?
Depreciation.
Right. So if we increase the value from book value to fair value, don't you think we're going to have some difference in depreciation that's going to have to be accounted for? If not, it's going to be out of whack, right? So this is what we're talking about, amortization of the excess, okay? We're talking about the excess of the value, the difference from the book value and the fair value from when we distributed the excess on the date of acquisition, right? Does that make sense to everybody? Okay. So everyone's good on how we account for the investment, right? Between the costs, simple equity, and sophisticated equity. Okay. Okay, now the elimination procedures. So the consolidation process is going to be performed independently each year. So this is an independent process every single year. As long as we have a controlling interest, we have to do it every single year at the end of the year. Okay? All elimination entries are going to be on a work paper only. Okay? So it's not on the general ledger of the parent's books or of the subsidiary's books. Okay? And I'm going to show an example of this once we get through these first couple of chapters that are dealing with this. I'm going to show just an overall picture of what the worksheet looks like, but I don't want to confuse us on that now, okay? I just want to just get through here because if you know the elimination entries, then all you have to do is plug them into the worksheet and then carry the balances over, okay? So it'll be simple once we get to theory, but so we'll get to that later. So just know that all elimination entries, okay, that we're making, like these entries here that we're going to be going over, they're not on the GL of either the parent or the subsidiary's books. It's only on the work paper. So steps for dates subsequent to acquisition. So the first thing that we're going to be concerned with is date alignment. Okay, so date alignment. This is going to vary by method. Okay, I'm going to get into what date alignment is, I believe, on the next slide. So just hang in there for a second. So the first step is date alignment. The next one, the EL, the elimination entry. This is the same from last chapter. Eliminate parent share of subsidiaries equity. Remember, so when we're going to eliminate that, do you recall how we do what with the parent share of the equity? Do you remember how we were debiting the common stock, debiting retained earnings, and then crediting the investment account? So that's the same thing we're talking about here. The D, distribute excess purchase price. Same thing we did last chapter. So that's where the difference between the book value and fair value of identifiable assets. So we distribute the excess to the relevant assets, right? And then the last one here is going to be the A, the amortize the excess. And once again, that's the difference from where we bring up the fixed assets from the book value to the fair value. Okay, so let's talk about date alignment for simple equity method. So the investment in sub carries information through the end of the fiscal year. So what we mean this investment in sub, this is our investment account, right? The line item on the balance sheet of the parent company, right? So when it says carries information through the end of the fiscal year, that means that we're accounting for our share of income or dividends or whatever it might be. So that investment account, the balance in it has changed from the date of acquisition because we've accounted for all the changes in the sub's retained earnings, right? Subsidiaries retained earnings is at the beginning of the year balance, okay? So the subsidiaries retained earnings at this point, because it hasn't closed or anything, has not changed. But we're still accounting for the differences because they're not going to close that out to the end of the year, right? So the subsidiaries' books, the retained earnings amount hasn't changed yet because they haven't closed that operating period down. So we have a little bit of a date mismatch here. So on the parent's books, the investment account is not in line with the retained earnings of the subsidiaries, okay? Because the parents is recognized stuff throughout the year, right? All the activity, which changed that account. And it's saying here the subsidiaries' retained earnings is unchanged. So what we need to do is back that activity, like back out that activity that we accounted for in the investment account under the equity method to make it match with the subsidiaries' beginning of the year data. Does that make sense? Okay. So we must align the content of the two accounts before eliminating the sub-equity against the investment account. So that makes sense, right? If we're going to eliminate the equity against the subs accounts, then it has to be at the same date, because if not, the amounts aren't going to align. So we want to eliminate the effects of the current year's recognition of income and dividends. Those are the only two things that we want to back out. Because if you recall up here, remember, we're taking the investment in sub, we're recognizing the parent share of income. Receipt of dividends is going to be a return of investment. So this is the stuff we're talking about right here. Okay? Sorry, went a little ahead. So those are the effects of the current year's recognition of income and dividends that we need to reverse out. So let's look at an example here of what the journal entries are going to look like for the simple equity method. So it says CY1. Eliminate current year investment income. So we're just going to do the exact opposite of the original entry. So we'll debit subsidiary income and then credit investment in subsidiary. So this right here eliminates the share of income of the parent of that of the subsidiaries that we've recognized throughout the reporting period, right? Because it's the complete opposite of what we just did on the first couple slides of how they account for it. Eliminate intercompany dividends. So this will be a debit to the investment in subsidiary, and then credit dividends declared by the subsidiary. Because remember, it's an intercompany dividend, so it has to be eliminated. Everyone good on these entries right here? It's just the complete opposite of what we did on when we recognized it. Now we just have to reverse it and back it out, so we're back to the beginning of the year. So it says here the investment in sub account has been returned to its beginning of the year balance. It has been aligned with the sub's retained earnings account. So does that make sense why we did that? So why did we do that again? It's because we recognize income, right? And our share of dividends, and the subs retain earnings in their equity accounts at the beginning of the period, so we need to back it out. Okay. Okay, further consolidation procedures. After data alignment is completed, then the cost method investment is converted to its simple equity balance at the beginning of the year. Same procedures regardless of method, simple equity or cost to account for the investment in subsidiary, okay? So now I just want to kind of get into these examples. I think that'll help instead of just harping on what it says right here, let you all just see what's going on through their journal entries. Okay, so the next steps, EL, eliminate the parent's percentage of the sub's beginning of the year equity. So this is the same as last chapter, right? Remember how we did the percentage of the equity accounts? That was our debit, and then we credited the investment in sub. Do you recall that from chapter 1? Okay, that's what they're talking about there. Distribute excess to controlling interest and non-controlling interest, okay? And we'll show that. That's the same thing we did last chapter. Amortize the excess. So this is the new step. Amortize the excess and date alignment is what this chapter is introducing. You all get the date alignment, okay? Y'all got that? Okay. Date alignment for the cost method. Investment account carries information as of the date of acquisition, okay? So cost method, we know that. All we're going to do is receive dividend income just as it normally would be, cash, credit, dividend revenue, right, or credit revenue. So investment account carries information as of the date of the acquisition. So for cost method, the date alignment is not worried about that, right? Subsidiaries retained earnings is at the beginning of the year balance. So must align the content of the two accounts before eliminating sub-equity against the investment account. So in this case, we convert the investment account to its simple equity balance as of the beginning of the year period. Required at the end of the second year and subsequent years, but not at the first, okay? So this is the date alignment at the end of the first year. So it's not applicable at the first year, okay? So they're not required in the first year. We can see it right there. But then the second year, we just want to eliminate the dividends because that's the only thing applicable on the cost method, right? Because we're not recognizing the sub's share of income. So the only thing that we even have to account for is the dividends we've received, right? So once again, we just reverse the entry for the dividends here. Okay, now we're still on date alignment with the cost method for the end of the second and subsequent years. Okay, so bring investment account to its simple equity balance as of its beginning of the year. Okay, so investment in sub, we'll debit that. And then we need to change the change in subs retained earnings since acquisition times the parent's percentage, okay? So this is the amounts that we're going to have here with this entry right here. So now we're bringing retained earnings. So if we credit retained earnings, it's increasing it, right? So now we have to bring it up to match, because it's the end of the first year that we're talking about. So now we have to bring it up to match what the change has been in retained earnings in the subsidiary for the parent's percentage. Does that make sense to everybody? Next, eliminate current year's dividends. So once again, same entry here. Okay, next for the elimination procedures, eliminate parent share of subsidiaries' equity. So this should look pretty familiar to last chapter right here. That look familiar to everybody? How we did that? That's the elimination entry, the first one we were doing. Okay, the main thing here I want to point out here, because we're all familiar with this, we're just taking the parent's percentage of their equity accounts and removing it, right? To remove this investment in subsidiary account. Look at how it says note here for the retained earnings, okay? It says controlling interest in the sub's beginning of current year retained earnings is going to be eliminated, okay? So it's always the beginning of the year. Okay, now how do we determine the method being used? Investment account balance is its original acquisition cost. So we know that's the cost method, right? Because that means we're not accounting for our share of income and then reduction in the account from dividends, right? So that we know that's the cost method. If the parent records subsidiary income, that is the sub's net income times the parent's percentage, we know that's the simple equity or the equity method, right? Now, if the parent records subsidiary income that is less than the sub's net income times the parent's percentage, that's sophisticated equity method. Why do you think under the difference between the equity method and the sophisticated equity method, when we look at the income percentages here, why is it saying here that parent records subsidiary income that is less than the sub's net income times the parent percentages? What's causing the sub's net income right here to be less than the sub's income? Why are they recording less than the sub's net income as opposed to they're recording all the income right here? What's the one difference between those two methods right there? I'll give you a hint. It's one of the two differences from this chapter to the last chapter that we're accounting for.
The amortization.
Right, because when you amortize or depreciate something, what account does that hit? When you realize depreciation expense or amortization expense, what account is it hitting, or what financial statement? Your income statement, right? Because you're recognizing expense. You're also increasing your contra account on your balance sheet. You know, your accumulated depreciation or accumulated amortization. So if we're going to recognize excess depreciation, then obviously we're going to recognize less than the subsidiary's share of income, right? So that's why we're recognizing less. Okay, does that make sense to everybody? Okay. Okay, complicated purchase, several distributions of excess, okay? So this should look a lot like the little charts we were going over from last chapter, right? And really, there's only one step added to the end of it. We're going to go ahead and just walk through it because practice makes perfect, right? Or as close to perfect as you can be. So, determination and distribution of excess schedule. Okay, company implied fair value is $900,000. How do we get the company's implied fair value? Do y'all recall that? If it's not given, remember it's based upon what the parent's going to pay for the percentage that they pay. So with these two items right here, how do you get this amount right here?
You add them.
One's a numerator, one's a denominator. So you take, this is the numerator, 720,000 divided by 0.8, and it's going to give you the implied fair value of 900,000. Okay, so I just want to throw that step out there. If you recall that from last chapter, to get the implied fair value, it's based upon the price the parent's paying for the percentage that they're purchasing into. So the total price paid by the parent, in this case $720,000, if you divide that by the percentage of ownership in which they're purchasing, that's gonna yield what the company's implied fair value is going to be. And then from there, obviously, the difference between the company implied fair value and the parent's price that they pay for the percentage is going to be the remainder for the non-controlling interest value. So does that make sense just to how we get the first line to just start from here, just in case the company's implied fair value is not given and you have to find it? That's how you find it. Okay? So once again, company's implied fair value is just the price the parent paid divided by the percentage of ownership that they're acquiring. That'll give us the company's implied fair value of $900,000. Obviously, 80% of that is the 720, and then obviously 20% of that is 180,000. Then from there, we back out the book value, right? The book value is what of a company? The equity, right? Or net assets, either way, same thing. But yeah, that's the book value. So now you can see the components of equity here, and we're just going to eliminate them out, right? So total shareholders' equity in this case is $500,000. Remember, we just carry it straight across in the column for that of the parent and the subsidiary. Then the next, we do the interest acquired. Remember, underneath here, just do your little, your math right here. Then the 720 less 400 is 320. 180 less 100 is 80. Then obviously the 900 less the 500 is the 400. So this is the excessive fair value over book, right? And this is the percentage of the excess fair value over book for both the parent and the non-controlling interest, right? And remember, this right here is where we distribute the rest in retained earnings. Remember, and I'll flip back to this is the one you showed me where it was in the last class when I couldn't find it. So that's how you allocate the remainder of the excessive fair value. Okay, remember on the bottom here, okay, so we know we paid the excessive fair value of $400,000, right? Now out of that, there's going to be some changes between the book value and fair values that were relevant at the date of acquisition. They're just giving them to us here, right? So we can see these amounts here. Inventory, 5,000, land, 50,000, building, 200,000, so on and so forth, okay? Now look over here to the right here. You can see how it says the life. So you can see buildings, $200,000, that's the difference. The life is 20 years, right? Same thing here, equipment, 5 years, patent, 10, discount on bonds payable, 4, all right? Notice the inventory here. We're assuming it's FIFO, okay? And we're also assuming that it was sold during year 1, okay? These right here, the amount per year, these are just the amounts, obviously, 200,000 divided by 20 is 10,000. So these are amounts of the excess that we have to amortize each year, right? Okay, so and we're keeping track here with what we're accounting for on the success here. So it's nice they give us the identifiable accounts right here, plus with the life and all the data that we just had, right? So the entry we're going to make on this, distribute the excess of the for the distribution schedule right here. First thing, let's start with cost of goods sold here. So why are we debiting cost of goods sold instead of inventory here for the amount of inventory on hand here? Because this is the end of the first year, okay?
Sold in the first year.
Right, because it says it's sold in year 1, right? So we can see here, here's a little star to it. Let's just see what the star says here. Inventory valuations are going to be distributed as follows. Okay, on the date of acquisition, we're gonna bring it to inventory. So last chapter, if at the date of consolidation, if it was inventory was higher, we just charged it inventory, right? Well, in this case, it's assuming it's sold, so now we have to charge it the cost of goods sold, because we know if we have inventory on the balance sheet and then it's sold, it enters into determination, of net income through cost of goods sold, right? Inventory turns into cost of goods sold. So that's why we're doing that there. It's assumed sold in year 1. Next, the land. The difference in the land between book and fair value was 50,000. So now we're just doing the same thing we did last chapter, right? We're just bringing the accounts up to the fair value, right? Buildings, 200,000. Now notice here, equipment. It was actually worth less, right? The fair value was worth less than what the book value was. So you notice we're crediting it here, right? Why are we crediting the equipment? Because it's going to reduce the value, right? Because it was actually worth less. So I just wanted to point that out. The other ones are all worth, or we're all bringing it up, so we're debiting it. Difference is going to be the goodwill, right? And notice here, remember, we have to distribute the excess paid over the fair value, remember? Remember that the thing that you showed me last class? This is the amount. This is how we find that. Just from the implied fair value. So the fair value over that of the book value. The proportionate shares, that's going to be how we allocate it right here. That makes sense to everybody? Everyone's good on that? Not too bad, right? Okay, now this is going to be the A, the amortization entry. This is the new step here, okay? So it says here, first year, current year amortization is recorded as an adjustment to expense. And then it says the balance sheet account is going to be changed accordingly, okay? Okay, so we know, obviously, if it is an expense is a debit, right? So now we're accounting for that amortization, the excess of that, the difference between the book value and fair value. So we're just going to take those figures that was given. Once again, we can see them down here, what the amortization per year is. So let's look here. For buildings, it's $10,000 a year. So depreciation expense buildings, $10,000, right? That's going to hit our income statement. So that's how we're reducing and recognizing less than the subsidiary share of the income, right? For the sophisticated equity. Makes sense? Okay, accumulated depreciation buildings, $10,000, balance sheet account. That's increasing our contra account. Next, equipment. Remember, equipment was actually worth less. The fair value was less than what the book value was on the date of acquisition. So now notice here we're debiting accumulated depreciation equipment because now we want to back this down. We want to notice less accumulated depreciation because it's actually worth less, and then we're going to credit depreciation expense equipment. Okay. So once again, why are we doing that? Why is that the opposite entry there? It was less, so we need to bring it down. We need to reduce the accumulated depreciation and reduce our expense for depreciation. Other expenses, we can see the patent. It's $2,500 a year, so other expenses $2,500 hitting our income statement, and then the patent is being reduced and the carrying value on the balance sheet. Interest expense, this is for the discount on bonds payable. So remember, if we sell a bond at a discount, then obviously it's going to increase interest expense as we amortize it. So that's why we're debiting interest expense and then crediting discount on bonds payable. Everyone good on that? Pretty straightforward, right? Okay. Now this is subsequent years, okay? So this is the year after the current year. So this is, let's say this is year 2, okay? So once again, current year amortization is recorded as an adjustment to expense, same thing we just did. But this time the balance sheet account is going to be changed for all years of amortization, okay? And then it says prior year's amortization allocated to the retained earnings parent and retained earnings of the subsidiary. So let's just back up here. So once again, same thing. This is a subsequent year. This is year 2, all right, after acquisition. Depreciation expense buildings, remember, for the current year, it's $10,000 right here. Accumulated depreciation buildings, 2 years worth, $20,000 now, because we want to keep track of our difference between the book value and fair value, right? That's what it's saying here. Balance sheet account change for all years amortization. Okay. Next, the equipment, same thing. Accumulated depreciation equipment, debit that, $8,000 right here, because this is going to be the accumulation, right? See how we accumulated it over here? So it's on the debit, so it's $8,000, and then the current month's the reduction of depreciation expense on equipment of $4,000 credit to reduce our expense. Other expenses, same thing. Recognize our period share, the $2,500 of amortization, then credit it. The patent, 2 years, $5,000. Interest expense, same thing for the amortization of discount on bonds payable, and then credit the discount on bonds payable for double that amount. Okay? Now here it says prior year's amortization is allocated to retained earnings of the parent and the retained earnings of the subsidiary. Okay, so look at the little charts right here. Okay, so this is our current year. We just accounted for all these items right here, right, within these entries. Okay, the prior years, notice that all these sum together equal $11,810, right? So this is the prior year's excess of amortization. So we want to allocate that between the two based upon the ownership percentage. So you just take the amount of the total amortization for the year, okay, and then you allocate it between the two. Oops, sorry, I think I moved up. Sorry. Everyone makes sense? Does that make sense to everybody? Everyone good on that? Anything sticking out, looking really difficult and just not making sense to anybody? Okay, the effect of the sophisticated equity method. So what are the ramifications of it? Current year's equity adjustment is net of excess amortization. So what's that saying right there? Current year's equity adjustments, remember? Equity, obviously, if we're recognizing the subsidiary's share of income, which income closes to equity, right? So current year's equity adjustment is net of the excess amortization. So meaning it's going to be reduced by the net amount of the excess amortizations, right? The investment account contains only the remaining unamortized excess applicable to the investment. So those are the ramifications. Distribution and amortization of excess procedures are altered. So distribute the remaining unamortized excess applicable to the controlling interest to the balance sheet account. Adjust the non-controlling interest for the remaining excess attributed to its share. Amortize the excess for the current year only. Okay? That's pretty much just going over with what we just saw on the previous slide. Everyone good? Oops, sorry. Okay, intra-period purchase. What do we mean by intra-period purchase here? Now we're going to assume that the parent company is purchasing another company like mid-year. Instead of like at the beginning of the year, it's like mid-year. So say they purchase them in June or July, one of the two. So under the simple equity method, the D&D schedule is based on subsidiaries' equity at the purchase date. So we're not going to be concerned with the beginning of the year balance. If we buy in on January or June 1, we're concerned on the equity balances on June 1 of the subsidiary. The sub closes the nominal accounts on purchase date. What do we mean by closing nominal accounts? Same accounts you close on a closing process, right? The temporary accounts, your income statement accounts, your revenues, expenses, gains, losses are going to be closed to the permanent accounts, meaning balance sheet accounts, assets, liabilities, equities, okay? So sub closes nominal accounts on the purchase date. Consolidated income includes subs income from the date of purchase, okay? So now instead of just recognizing all their income from the period, we're only going to add to the parent share of income from that date forward. So from like June 1 to December 31st, that's the only share of income we're going to recognize, because that's the only thing that's relevant to us, because we didn't have any interest in the company prior to that, right? So we're only concerned with their income beyond that date, right? Makes sense to everybody? Only subsidiary income earned after the purchase date is distributed to the non-controlling interest and controlling interest. Once again, just expanding on what I just said. We're only relevant from the date that we actually purchased in until the end of the year. The cost method is going to be the same as the above, except eliminate the intercompany dividends only. We know that the cost method, the only thing that's relevant is the dividends, right? Cost to equity conversion is from date of purchase. Okay, so the worksheet technique, and once again, we're going to look at this worksheet later on in the class. Probably next week is when we'll take a look at it, or the following. So extend all account balances to the correct column. So we'll get to this. I'm just going to read through it here. Like I said, we'll reassess with this at a later time. Assets and liabilities and parent paid in capital to balance sheet column. The parent's retained earnings to the controlling retained earning column. Non-controlling interest in subsidiaries' equity and subsidiaries' dividends to the non-controlling interest column. Revenue and expenses to the consolidated net income. Parent dividends to the controlling retained earnings. Calculate consolidated net income, distribute and extend to the non-controlling interest to controlling retained earnings. And then calculate the ending non-controlling interest to controlling retained earnings. Extend the balance sheet. I know that just sounds like a lot of Chinese right now, but that's the process. And like I said, once we actually see it, it's not bad at all, okay? And like I said, we'll look at it in the next week or two. Okay, income distribution schedules. For the subsidiary, obviously they have their internally generated net income, right? So whatever they produce as far as their operations internally. Plus other adjustments, if any, whatever they might be. Minus the full amortization of the excess. And that equals the adjusted income. From there, you just multiply it by the non-controlling interest share, and that's distributed to the non-controlling interest. For the parent, it's just the internally generated net income plus the parent share of the subsidiary's adjusted income, okay? And that's going to be the controlling interest. Let's see. Okay, yeah. So these are the last two slides here. Then we'll get into if you have questions, and we'll start focusing on Chapter 2's homework. And like I said, if you want to get into questions for this chapter more in depth, we can, or we can get out of here early. So goodwill impairment losses. The impairment loss is reported in the consolidated income statement for the period in which it occurs. Okay, so we're concerned with this on the consolidated income statement. It's presented on a before-tax basis as part of continuing operations. Okay, so that's where it's going to be the line item on the income statement. Before-tax basis as part of continuing operations. Now, recognizing and recording the impairment, the parent records its share of the impairment loss on its books and credits the investment in subsidiary account. The non-controlling interest share of the loss is recorded on the worksheet, or the impairment loss could be recorded only on the consolidated worksheet. So let's just take a look at a little quantitative example here. So once again, this is dealing with goodwill impairment losses. So look at the calculations. So the estimated fair value of the 80% of the subsidiary is $900,000, right? So that's the estimated fair value. Estimated fair value of identifiable net assets is $850,000. So the estimated goodwill is going to be $50,000, right? That makes sense to everybody? The existing goodwill was $165,000, so obviously the impairment loss is going to be the difference between the two, right? $115,000. So once again, this is pretty much, this should be a review for everyone because we had it last chapter, and then this is something like we said. I believe it was covered in intermediate as well. So the parents' journal entry, they said we recognize the goodwill impairment loss of their percentage, right? So once again, just the overall impairment loss times 80% in this case is their parents' share. And then we credit the investment in the sub because that's going to reduce our investment because we've took an impairment loss. On the consolidating worksheet, record the remaining $23,000 loss, okay? Does that make sense to everybody? Okay, and the last three slides, yeah, these are the last two learning objectives that I'm not going to cover. What's sticking out is like troublesome right now? Does anything seem really difficult now? You see how it's just pretty much the main thing we're concerned with on this chapter is the date alignment, right? Because remember, this is subsequent to acquisition, right? So we're accounting for the periods of activity now beyond us having made that acquiring a controlling interest, right? The other thing we're worried about is the amortization of the excess, right? So is everyone's good on those two concepts? Okay. I believe on the homework for this chapter, the first question is just understanding the issues for chapter 3 here. And it's just going to ask you how you would account for income under each of the sophisticated equity, and the cost. And then what the balance of the investment account would be at the end of the reporting period. So that's pretty straightforward. We covered that in the beginning. I believe the second question is just the distributing the excess. So you're gonna go through and you're gonna figure out the implied fair value and stuff, and then you're gonna allocate the excess to whatever the relevant assets are, and then I believe it has you doing a little bit of the amortization, and then just a couple journal entries, and that's it on that one. And then there's one on impairment loss. So something sort of like this right here. Those are your three problems for this chapter. Okay, everyone seem good on that? And once again, we'll review them in the next class period to make sure everyone's on the same page with it. So is everyone good on chapter 3 right now? The date alignment and the amortization of the excess didn't throw anyone off. Okay. So now let's go ahead and look at chapter 2 homework. Okay. And once again, until I get my Elmo, which even then I kind of like just putting it up here and talking about it right now. Has everyone completed chapter 2 homework, or have they started on it yet? Not really. If you haven't, it's fine. I mean, I get it.
Started on it. I'm working my way through it.
Okay. Well, we're still going to review through it. When was chapter 2 homework due anyways? Just so.
Tonight.
Oh, is it tonight? Okay, I thought it was. Okay, yeah. So we better go over it, huh? Okay. And I'll have it posted. I'll make it visible to where y'all can just click on the link and you'll have all this right in front of you. But I still want to go over it. Okay. So chapter 2. Okay, so understanding the issues, number 3. So it says Paulos Company purchases a controlling interest in Sanjoy Company. Sanjoy had identifiable net assets with a book value of $500,000 and a fair value of $800,000. It was agreed that the total fair value of Sanjoy's common stock was $1.2 million. Now we want to use value analysis schedules to determine what adjustments will be made to Sanjoy's account, and what new accounts and amounts will be recorded. Okay, the first scenario is if Paulos purchases 100% of Sanjoy's common stock for $1.2 million. Okay. So the first one, once again, we assume that Paulos purchased 100% of Sanjoy's common stock for $1.2 million. So here's our value analysis schedule again. Do I need to make this a little bigger? Would that help, or is it okay?
A little bit bigger.
little bigger. That better? Okay. I think that messed it up a little bit, didn't it? Yeah, let me go down just a little. I'm sorry. It might not have, but it looks like it did a little. Okay, I think that's right there. You'll see that. Okay. Okay. So once again, Paulos purchased 100% of Sonjoy's common stock for $1.2 million. So obviously, if the parent's going to purchase $1.2 million, the purchase price for 100% of the stock, then the implied fair value is that, right? So the company's fair value is going to be $1.2 million. The parent paid $1.2 million, right? Fair value of net assets excluding goodwill. Remember they said it was $800,000. The book value was $500,000. So goodwill in this case, remember fair value of net assets excluding goodwill, because we don't include goodwill. Remember, goodwill is not included when if it's already on the books of the company being acquired. So fair value of net assets excluding goodwill was $800,000. So obviously, the price paid over the fair value of the net identifiable assets is goodwill, right? So $400,000 is goodwill in this case. So net assets are marked up $300,000. Obviously, $800,000 fair value less the $500 book value, right? And then goodwill, like we said, is $400,000. 1.2 minus $800,000. Pretty simple, right? Makes sense to everybody? Okay, now let's assume that Paulos purchases 80% of Sonjoy's common stock for $960,000. Okay. Sorry, just bear with me here. So once again, they paid $960,000 for 80%, right? So that's what the parent's paying for 80% of the interest. So how do we find the company's implied fair value based upon what the parent paid? Not multiply, divide it. What's your numerator? The one on top is the price paid, right? Divided by the percentage. And that'll give us the implied fair value. So 960 divided by 0.8 will give us 1.2 million. Then we have the company's implied fair value. Obviously from there, we're going to go ahead and determine the percentages out of the 1.2. They're given here. Once again, the fair value of the net assets, excluding goodwill, remember excluding goodwill, was $800,000, right? And it's got it moved over here. Sorry, it's a little sloppy here, but this 800,000 right here should be over here, the 640 over here, and then the 160 over here. So I apologize about that, okay? Just bear with me here. So goodwill, total goodwill was 400,000, right? So of that 400,000, 320 of it goes to the parent. That's 80% of it. The other 20 is the 80,000, okay? Once again, net assets marked up 300,000. 800,000 fair value less the 500,000. Now, this is kind of a trick question right here, because if you recall, you still, even no matter what the percentage that the parent owns, right? If it has a controlling interest, if the parent owns 80% here, you still mark the assets all the way up to fair value, right? Regardless, because that was the trick in this question right here. People might only mark them up 80% because of the parents, but you mark them the whole way up, right? Because remember, we distribute the excess into the equity at the end based upon these numbers here, remember? Net assets marked up 300,000. That was the trick there. Goodwill's 400,000, same as before. The non-controlling interest would be valued at 240,000, which is 20% of the implied company value to allow the full recognition of fair values. So that's how we do the implied fair value. Once again, like that. That's how we get that. And by doing it that way, we can mark the net assets all the way up. Okay, so that's why we're doing it that way from the beginning. Does that make sense to everybody on this problem? No questions on that? And once again, this will be available in Moodle once, I'll make it available before we leave here. That way everyone has it. Okay, now let's go to number 4. Is that okay for everybody? 'Cause I don't want to start distorting it again. Okay. So number 4 says Pillow Company is purchasing a 100% interest in the common stock of Sleep Company. Sleep's balance sheet amounts at book and fair values are as follows. And on page 98, I don't know if anyone had the book, but if not, I'll just read through it. I don't know if someone want to follow along. So we have current assets, fixed assets, and liabilities are the accounts that we're concerned with here. Difference: the fair value for current assets is $250 compared to the book value of $200. Fixed assets, fair value $800,000 compared to the book value of $350, and then the liabilities are the same of $200,000. So it says here, use valuation analysis schedules to determine what adjustments to record values of Sleep Company's accounts will be made in the consolidation process. If the price paid for the 100% is $1 million for Part A or $500,000 for Part B. So let's look at Part A first here. So once again, it's saying that the company's parent price is paying $1 million, right? So for Part A, we're assuming they're paying $1 million. And if they're getting 100%, so the non-controlling interest is not even going to be a concern here, right? Obviously, if the parent is buying 100%, once again, the full price right here is the company's implied fair value. Fair value of net assets, excluding goodwill, was $850. I believe that was given. Yeah, it was given. We just had to do the math here, from the different of the accounts shown. So obviously, goodwill in this case is going to be the difference between the price the parent paid over the fair value of net assets, excluding goodwill, right? So there's our goodwill. Now, the determination and distribution of excess schedule would make the following adjustments. Okay, $1 million for the price paid for 100% of the firm, minus the $350,000 net book value equals $650,000 excess to be allocated, right? Remember, it says we paid $1 million, $350,000 was net book value, so $650,000 is the excess. And then we just have to remember the current assets fair value was $50,000 higher than the book value, so we're going to debit current assets. Fixed assets was $450,000 higher, so debit fixed assets $450,000, and then the difference between that, the difference right here, the excess allocated between what we can identify is going to be plugged as the goodwill, obviously, which was given here matches the $150,000. So that makes sense, right? That's just the same thing we were going over in chapter 2, just how we go through what they paid, try to find goodwill and what the excess paid over it, and then just what asset the accounts need to be adjusted for, right? That's all we're doing right there. Make sense to everybody? These questions look a lot harder, and then when you kind of see the answer, it's like, oh man, makes sense, because it kind of goes off how the slides look, right? I want to point out, you don't have to do it this way exactly. If you have another way you want to go about finding the answers, like how you want to write it on your paper, I'm fine with that. This is just how this author chooses to do so. I think it's a neat way of doing it because it kind of keeps everything in line.
I was going to say, I did mine a weird way, but I kind of like that better.
But whichever way, I'm going to say, to each your own, you know what I mean? Whatever works, if it works, if it is not broke, don't fix it. Just do whatever. If it makes sense to you, do it. As long as you get the right numbers, I don't care how you get them, okay? Okay, so we've got Part A here. Now let's assume we're paying $500,000, right? So obviously, if we're paying $500,000 and the fair value of net assets excluding goodwill is $850,000, then obviously we're gonna have a gain on this one, right? Why? Because we paid less money than what the actual value, the fair value of what we're acquiring is, right? So we've come out ahead economically by that purchase, right? By that transaction. So once again, company's fair value, the implied fair value obviously is going to be the same as the parent price, the 100%. Once again, fair value net assets, if nothing's changed from up here, it's $850. So our bargain purchase gain on acquisition is going to be $350,000. The determination and distribution of excess schedule would make the following adjustments. So remember, $500,000 in this case is what we paid. But remember, the net book value was $350,000. So the $150,000 excess is going to be allocated to the current assets, because remember there's a $50,000 difference. $450,000 difference on the fixed assets. And then the gain on acquisition is going to be the credit amount here, which will go ahead and reduce. If you net all these together, it's going to bring us back to the 150 on the goodwill rate. Or I'm sorry, the 150, which is the difference up here. Sorry. Does that make sense? So one's just showing a bargain purchase, the gain on acquisition. One's just showing the goodwill, and then how we allocate the excess. Not bad, right? So pretty much on these problems here, if you can find the company's implied fair value based upon the percentage of ownership, right, that they purchased. If it's not given, and how do we find the company's implied fair value?
You divide the price paid by the percentage owned.
Of the parent, right? And that'll give us the implied fair value. That's that. And then from there, we just take the data given from the difference between book values and fair values. What are we concerned with on consolidation?
Value.
Fair values, right? Okay. And then we're just distributing the excess. Once we find the difference, distributing the excess to the assets. This, like I said, this is just one example's a gain, one's a goodwill. Everyone good on that? Makes sense? Okay, exercise 2-4. Recording purchase with goodwill. So it says Woolco Incorporated purchased all their outstanding stock of Paint Incorporated for $980,000. Woolco also paid $10,000 in direct acquisition costs. Just before the investment, the two companies had the following balances, okay? So we go through here, we have our assets and liabilities and equity, and we have each company's amounts here, okay? I'm not going to just read through them right here because it's going to be impossible to keep track of them right now anyways, just in our head. I'm on page 100, exercise 4, if anyone's following along. So it says at the bottom, appraisals for the assets of Paint Incorporated indicate that fair values differ from recorded book values for the inventory and for depreciable fixed assets, which have fair values of $250,000 and $750,000 respectively. Okay, so it's saying prepare the entries to record the purchase of the Paint Incorporated common stock and payment of acquisition costs, okay? Okay, so here's the answer to number 1 right here. So this is the entry. So obviously it says that they purchased all the outstanding stock for $980,000, right? So obviously we know we have that investment account. We debit the investment in Paint Incorporated here for the full amount, $980,000, and obviously we paid cash for it. So we're crediting cash, right? What do we do with the acquisition costs again? I know it's given here, but what do we do? What is that entry accomplishing right there? We expense it in the period incurred, right? So acquisition costs are always going to be expensed in the period incurred. So there's number 1. Okay, number 2, prepare the value analysis and determination and distribution of excess schedule for the investment in Paint Incorporated. Okay, so once again, we paid $980,000. Let me try to make this a little larger here. Okay, so once again, we paid $980,000, right, for 100%. So we know that's going to be the implied fair value because it's the 100% of itself right there. It says the fair value of net assets, excluding goodwill, was $900,000, okay? And right here is going to give us how we got that right here, okay? So obviously, goodwill is going to be $80,000, right? And it becomes from the $700,000 net book value. And I know it's hard not looking at these accounts here. That's why I really wish I had this Elmo. We could be looking at these statements right here. Thank you. So it's the $700,000 net book value plus the increase in inventory of $50,000 plus the $150,000 increase in depreciable fixed assets is going to be the $900,000 fair value. Okay, so that's where we get that right here. So once again, the fair value of net assets including goodwill backed out from the fair value or the price paid from the parent is going to give us goodwill. We've already established that. Okay, now we'll do the determination and distribution of excess schedule, just like we've been looking on the PowerPoints. Knock this down to the next slide. Not boring you all too bad, am I? Okay, once again, we paid $980, right? Less the book value of interest acquired. Remember the book value, gosh, that's all over the place. Book value is their equity, right? So we're going to back out the equity. So total stockholders' equity is $700,000. So obviously 980 minus the 700,000 will leave us the 280 right here. So the excess of fair value over book value of 280. So the adjustment of identifiable accounts, once again, the given amounts here, this is all we're doing is bringing from the book value that was on the investees books, sorry. So we're going to bring those up to the fair values at the date of acquisition, right? So that's what we're doing on these right here. The inventory, obviously, for the difference of 50,000. Depreciable fixed assets for the difference of 150,000. So we'll debit that 150, and then the difference of goodwill of the 80,000 right here. Does that make sense to everybody on the distribution? So not bad, right? Just distributing the excess. Because it's pretty much everything's given on the difference between book value and fair value. You just have to plug it in where it belongs. Okay, and on the third one it says prepare the elimination entries that would be made on the consolidated worksheet. So remember, this is where we're doing those elimination entries, remember? So what's the first eliminating entry that we have to do, even though we can see it here? What is it? We want to eliminate the parent share, the investment account, against the parent share of equity of the subsidiary, right? So in this case, we own all of it, right? It's 100%. So we're removing the investment account against all of that of the equity accounts of the subsidiary. So in this case, these are the equity accounts, once again, of the subsidiary. We debit those credit investment account right here for $700,000. Then next, remember, this is just where we're allocating it like we just did up here. Okay? We allocate it to the excess to the relevant assets, and then credit the balance of the 980. Remember, because there's 280 balance left because there's a total of 980 the price paid. So the investment account's been totally eliminated, right? Make sense to everybody? So you can kind of see what the most important slides are on the PowerPoints. It's those D&D schedules and the elimination entries. I mean, obviously all the slides are important, but you can see by working through these problems, if you look at those, you should be able to pretty much build these problems. Does that make sense, how it goes hand in hand with what we covered in the lecture? Is anyone lost on any step from any of these homework assignment problems right here? Anything from chapters 1 through 3 that's just not making sense right now? Everyone's good on goodwill impairment. Everyone's good on the difference between what goodwill is and gain on acquisition, bargain purchase. Everyone's good on date alignment, on subsequent acquisition. Okay, what is the date alignment again? What are we changing? Subsidiaries, I'll tell you one part of it. Subsidiaries retained earnings is at the beginning of the year balance, right? So what do we have to adjust on the parent? On the equity method, right? Cost, remember, it's just dividends in the second year. But in the equity method, we're accounting for something, right? Throughout the period. Our share of investees' income, right? And dividends received. So we have to back those out. That's the matching, or bringing the date alignments together to the beginning of the period. Okay, sophisticated equity to the equity method. Why sophisticated equity? Why do we recognize less than the subsidiary's percentage, or subsidiary's income times the parent's percentage? Why does the sophisticated equity account for less than their share of income? What's the difference there? Amortization. The amortization of the difference of where we brought the book values up to fair values. So once again, this chapter just introduced those couple concepts. How we kind of account for, really three, how we account for income, right? Which I think we touched on that a little bit in the last chapter. So it's how we account for income throughout the period, throughout the different levels of influence on as an investment. Date alignment, okay? Where we reverse the activity in the parent's account back to the match the subsidiary's retained earnings, and then amortization of the excess. Because remember, we have to bring those book values and fair values, so that's going to throw off our depreciation expense and accumulated depreciation, so that's the amortization of the excess. Everyone's good on that. Okay, once again, you all reminded me homework is due tonight, so go ahead. I'll go ahead while I'm thinking about it. I'm going to make this visible to everybody, so you have it. Alright, let me just make sure it opens up here so I'm not lying to you all. Alright. Yep, there they are. Everyone's good. Remember, I'm always available to help out if anyone needs help. My office hours are listed. You got my email address and everything, so just hit me up if you need help with anything. I'll be more than happy to help anyone any way I can. I hope I'm not boring everyone too much with the content. I know it is a difficult course. I'm trying to go through it and explain it the best way I can, so I hope I'm not losing anybody. And if I am, I'm sorry. Come see me if I am, but hopefully everyone's getting it. So that's all I have for tonight's class. I know we finished out of here a little early. It's always nice to get out of here a little early. So unless y'all have anything else for me, then I'm good. Just remember to get those chapters and 1 and 2 quizzes done as well. I apologize for having y'all back up in Moodle to access those. But like I said, remember, they're just real quick quizzes, 15 minutes each. Not too bad. So just go ahead and get those in. And I'll extend the date to the 8th, so the next Tuesday on all the quizzes. We'll make that chapters 1, 2, and 3 quiz due next Tuesday night. So is that fair to everybody? Is that enough time on it? Because I know that's 3 assignments there, but with me giving the homework solutions, that should take the weight off some of the stress of homework, and their quizzes are really short. And like I said, that's going to be a great review for the exam. So everyone good on that? So I'll go in and adjust all the dates to the 8th. All right, remember, get homework in tonight on time. And that's all I have for everyone. If no one has any questions for me. We're good? All right, cool deal. Well, I appreciate your all's time, and I will see y'all next week. And if for some reason we don't meet, I'll let you know. I'll cancel. So if you don't hear from me, plan on coming. And if you hear from me, then that means I'm canceling class. And I'll always try to give you at least 24 to 48 hours heads up so you can kind of plan your day, okay? So I'll keep you posted on that.